No. Good evening and welcome to tonight's Premium Account Market Update webinar. The information is prepared for general information of traders and investors. The information does not take into consideration the specific needs, investment objectives or financial situation of any person. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presented tonight, myself, Leon Hine, current Managing Director of Global Equity Management. The format for tonight's presentation, we look at the global macro outlook driving equity markets. We roll through the ASX top 50. We tie in the 2013 PE valuation, dividend yield, price targets and earnings growth, and overlay our derivative strategy and conclude tonight's recording with our 2013 market outlook. The services that we provide are up on screen there. If you'd like to know more about those, contact either myself or Christine, info@investorsignals.com. Moving straight into a graph of the US market, and I'll just go to overnight news that's impacting the market. So US stocks extended gains with the S&P 500 on track to post a 4-week winning streak after exchanges obviously reopened, or the US exchange reopened after Martin Luther King holiday on Monday. Investors continue to express confidence in the market after several better than expected earnings reports, further buoyed by sentiment. So far, some 73% of the 74 companies in the gauge of the S&P 500 that have released results so far have exceeded projections. On the whole, the S&P 500 corporate profits are expected to exceed $1 trillion this year, forcing some to believe that it may actually be difficult for the index not to breach its 2007 record highs. So all that quite positive. On the negative side, US existing home sales unexpectedly fell in December, but I suppose it's important to put that into context. The reading was still the second highest reading since November 2009. Further, on a macro level, the German investor confidence increased to its highest level in 2.5 years. And from a market standpoint, over the last sort of 24 hours, materials and financials have generally sort of led the market higher in the US. And that sort of feeds into what our base case has been for equities. And we've had a view for some time that roughly 12.5 times $100 of earnings for the S&P 500 works out at fair value for the Dow at around 12,500 points. We're getting a little bit of earnings results in this December quarter exceeding or at least meeting market expectation, and that was our base case. We expected that the Dow Jones or US equity markets would remain buoyant throughout earnings season, so we've got about another 10 days or so to go in the US to conclude fourth quarter earnings results, and I expect that those results will continue to underpin the market. And I'll relate that back to the Australian markets. There's an interesting sort of differential where we've seen the Australian market somewhat outperform as we've seen sort of further yield compression in the Australian market. But certainly the US at around 12.5, 13 times earnings, and the outlook for probably slightly better earnings growth than what we have arguably is setting up for a slightly better environment. But I still think, that being said, we're sort of pushing up into the top end of this current rally, and I would look for some level of pullback post-US earnings season, and maybe it comes in sort of mid-February around the US debt ceiling. And the knock-on effect of that US debt ceiling is if there is a lack of agreement there between the Democrats and the Republicans, you'd expect to see the US dollar surprisingly move a little bit higher, and that'll start to put a little bit of pressure on risk assets. But if in fact the debt ceiling is raised, all things being equal, it should be negative for the US dollar, and it should actually allow the risk rally to continue a little bit further, and that would set up the environment for the buy on dip view that we have in February. So right at the moment, US equity markets doing as expected, trending higher throughout earnings season, and from a valuation standpoint, there's nothing there that's too alarming. If we just have a quick look at the macro indicators that we've been following. So the euro dollar is, to a great extent, a bit of a risk barometer, as it's a reflection of whether we're seeing sort of a weak US dollar or not. So we've had this sort of environment where things have stabilised in Europe, and obviously that's allowed the US dollar to come off, the euro to rally. We were always looking for the euro to get back to around $1.30. It's pushed up a little bit higher to 133. The US dollar on the index is sort of sitting below that sort of 80 level on the index, trading around sort of bouncing between 76 to sort of 79 levels. And we would look for that to continue. So I think, I suppose, again, the issue that we grapple with is how is the US, how are the Republicans and the Democrats going to resolve the debt ceiling? Lessons learned in the past would suggest that, hopefully they're more willing to meet an agreement earlier than the deadline, but we know in the past that quite often these things come down to the 11th hour, so it probably wouldn't be a surprise that there's some level of nervousness in the market just in the days leading up to that, or the weeks leading up to that. So certainly if the market remains buoyant over the next week or two, I think that's an opportunity to start paring back some profits and keeping a little bit of cash on the sideline for a potential buy on the dip in February. From the European standpoint, the only real risk that we see on the horizon is the upcoming elections in Germany, which will take place in September. We've just seen sort of Merkel lose a smaller regional election over the weekend. So the prospect of sort of a socialist party getting in the full elections that take place in September could be seen as a negative for equity markets, given that Merkel has obviously been sort of pro the bailouts and reasonably quite supportive of sort of the ECB's action there within the Eurozone generally. So a different governing body coming in will probably at least somewhat sort of argue some of those positions that have been taken by the current existing government. So that's just something to keep an eye on, but not until sort of mid to later in the year. Further, just on that macro picture, to have a quick look at the 10-year yield on US Treasuries. So we've seen a rally in the yield from around sort of 1.4 back up to almost 2%. It's just started to come off a little bit in the last week or two, and really the relevance there is the market of the view that inflation is starting to pick up, and moderate inflation is a very important element to long-term equity market. Increases are certainly from sort of this deflationary problems that we've had, or the deleveraging problems that we've had globally since the GFC. So it's important that we just sort of keep an eye on the Treasuries as a benchmark every month or two, just to see what trends are emerging there. But ultimately we'd be looking for these to sort of stabilise with the yield at around sort of 1.7 to 2%, and gradually getting into the back end of 2013 start to see that gradually creep back up over 2%. Obviously with these yields coming down, and this is the desired effect by the Federal Reserve, it's forcing investors into risk asset, and we're seeing this hunt for yield in higher risk assets, and I'll get to that when we look at the XJO and the stocks in a moment. From our market standpoint, we're trading just over sort of approaching about 13.5 times forward earnings at the moment. A lot of stocks are getting very expensive from a PE standpoint, but investors are able to justify that high PE based on the dividend yield. So as we go through the top 50 companies, we'll focus on that tonight. From a valuation standpoint, again, we've been positioning portfolios through being our main macro theme in portfolios has been to remain long the resources, and we've been bullish our market for a bounce from December all the way through till, well, we've essentially been long the market since October, but we've been aggressively sort of participating in the commodity names through till the end of January as a basic theme. And we've sort of had a view, if you've listened to the webinars over the last few weeks or month, that we were looking for a small pullback. We only expected that to last a few days, and then we were expecting this rally to occur as US earnings season kicked off. We saw Wells Fargo, sort of the main US companies, report earnings last week. That was a little bit uninspiring, didn't do too much around the market, but as soon as we started to get into the results coming through from Goldman Sachs, from JP Morgan, we've certainly seen the market continue to rally. We've seen some of the technology companies in Google reporting their results, IBM reporting their results, all exceeding analyst expectation, and that's helping to add to this rally. But I think when we look at the valuations of our market, we'll start to see that a lot of the stocks are getting a little bit stretched, and I think the asset allocations and the way we approach the market starts to change a little bit at these levels. From an earnings growth standpoint, obviously we have our earnings season starting next month, and a lot of stocks start to go ex-dividend in February and into March. Again, based on current valuations, there's a lot of high expectations coming into this earnings season. I think in some cases they won't be met, but generally what's happening globally is money managers are having a greater level of confidence that global GDP is going to re-accelerate over the next 2 or 3 years, and we're starting to see equity prices really get ahead of the curve, and that's not unusual. It's not uncommon to see sort of equity valuations anticipate growth down the track and valuations to remain high, but we're certainly getting into a point where 2013, the back half of 2013, has to deliver the pickup in global GDP to support some of the valuations that are applied to equities at present. So again, that just feeds into our view that we start to get a little bit more cautious and we adjust the allocations in portfolio and put a little bit of cash aside for a potential pullback over the next sort of 3 to 4 weeks. On that note, moving straight into the top 50 stocks. So the XJO, or AJK, I should say, expecting about 10% earnings growth there. We were buyers of it at lower levels at around this sort of $14.50 level. We've largely been sellers at sort of $15.50 or $16. So we're delivering a bit of AJK tomorrow into option expiry at around this $15.50 level. If we go out further where we're holding it longer term for clients around June, we've capped it out at around $16. We've got the upcoming dividend of 30 odd cents. And I'd expect in the absence of, or with that dividend being paid out, the stock will probably present another buying opportunity over the next month or two. So we'd look at becoming buyers again of AGK on a pullback at around $15. Asiano, not doing there at present. Amcor, so we've been buyers of this off the dip a number of times throughout this rally at around 15.5 times earnings up here, delivering about a 4.5% forward dividend yield. The stock, we've always had a view at around 850 probably caps out full value for Amcor. The strategy here has been to own the stock and try to get the calls set at around that 851. We're looking for the stock to bounce in the next few days, a week, back up to around 850, and that would give us the opportunity to sell the calls, and that would ensure that we're getting around 16-17 cents a premium for those calls, plus the 19-20 cents a dividend to be paid in the next month or so, and then some capital gain from owning the stock at lower levels and ultimately having the opportunity to deliver it around 850. But Amcor should deliver about 8 to 10% earnings growth, and it's a stock that we're reasonably comfortable with that should meet earnings guidance as we get into the earnings results in the month ahead. AMP continuing to push higher. After owning it at lower levels, we started taking profit at around $5.10. The argument for AMP is that it still provides a pretty reasonable yield of around 5.5%. It has exposure into Asia. There's still synergy costs that may yet to be fully realised from the AXA acquisition. And the enlarged footprint that AMP has as a result of the AXA deal gives them greater product exposure into Asia. Now, in saying that, the company is expecting earnings to be reasonably flat in 2013. So from here on, it really is majority of a yield play, and it may push a little bit higher, but certainly we wouldn't sort of re-look at AMP unless we started to see a bit of a sell-off and a pullback to below $5. ANZ, on the other hand, we're happy continuing to be buyers of ANZ. Again, we own it after the accumulation indicator, triggering sort of this buy on dip here with this higher high and higher low structure. The banking sector is only going to deliver about 5% earnings growth at best. I've been chatting in detail about sort of the low top-line revenue growth and the focus on cost savings. the add back of provisioning that they've made for bad debts that are helping to deliver the earnings growth profile of the companies. In saying that, I think if we go out 12 to 18 months, that earnings growth rate's likely to pick up a little bit if we have this backdrop of better global GDP. The stocks are trading at about a 5.5% yield plus franking credits at the moment, but tied in with this view that the US equity markets could quite possibly push a little bit higher as we sort of get through the next week of earnings results in the US. Still comfortable owning the Australian banks at these levels, in particular ANZ, Westpac and NAB. In the case of ANZ, I think we could push up to around sort of about $27 before we start to look at taking some profit on these long positions from lower levels. ASX are getting expensive, and we're starting to see a few firms come out with sell signals here. Again, I think it's a play that's supported by dividends, so it's a bit hard to get bearish on ASX. But again, we've started a lock-in profit here on ASX after owning it at lower levels. The stock's delivering at about 5 and a bit % yield at these levels. From an earnings growth standpoint, I think the 2013 result's going to be pretty flat, if anything slightly negative. And we haven't seen a significant pickup in market volumes, so this is a real example of where the market is chasing defensive yield coming into dividend period, but also getting excited about the prospect of if global GDP does recover, ASX will be an ultimate beneficiary of market volumes returning to normal. But in previous months we spent a lot of time looking at those trends in market volumes, and they're sort of 20% below their historical averages. To some extent there's probably a little bit of corporate activity premium starting to get repriced here into ASX after some of the recent offshore sort of consolidation within the exchange services. That being said, we're comfortable that we're doing the right thing, taking profit at or near these levels, and again we start to have a look at it as a buy on the dip opportunity in the next month or two ahead. AZJ, so again we've been buyers of this at lower levels. We've capped the stock out at around $4, so we achieved roughly around 13 cents a premium for that. We've got the upcoming div, and on an annualized basis that trade will deliver in excess of sort of 20-odd% return. So our view at the moment is for clients that are not set in AZJ or Horizon, it's certainly a stock that we'd be happy to buy on the dip. If the sell-off in equity markets does come through sort of in that mid-February period, we'd be a buyer of AZJ back at around the 370 level, trading at about 19-20 times forward earnings. The stock's expensive. There's a high expectation of earnings delivery to come through. Arguably the market's putting a bit of a premium on AZJ as a result of the potential breakup of the business or divesting of some level of the assets in the business. But all that being said, at around $4 the stock starts to look pretty expensive to us, so we're happy to cap out the gains at or near that level. So BHP around sort of 15-16 times 2013 earnings. That number comes down with sort of when you factor in the spot price for iron ore coming into 2014. If iron ore and oil was to stay at or near current levels, we see that PE ratio coming back down to about 12.5, 13 times earnings. So whilst it looks expensive short term, go out 12 months, I think that valuation starts to look a little more attractive. We're seeing GDP in China accelerating back up to around 8%. The December quarter numbers are looking strong, and I think that sort of feeds through. We're seeing a significant amount of stimulus from the Chinese government going into large infrastructure projects, and that's something that we sort of spoke about 6 months ago as a theme that we're looking to get more traction on around this sort of Christmas period or December period, and we've benefited from being long sort of BHP and Rio over the last number of months. So the key question is there more to go in this rally? And I think there is. I think the probability, so we saw the quarterly results come out of BHP today. The energy portfolio is starting to show signs of improvement after disappointing sort of over the last 12 to 18 months. And certainly from the iron ore standpoint, the company slightly exceeded expectations there, or guidance. So from a valuation standpoint, our view really hasn't changed. I think in line with the equity markets possibly pushing a little bit higher, it still makes sense to have exposure to BHP. Happy to cap that out at around the 39.50 level over the months ahead. Bramble, so again trading up at about 19 times earnings. The company's guided to 5 to 10% earnings growth, yet the market's starting to value the stock on the expectation the company's going to deliver around 15% earnings growth. So I think this is an example where the market's probably getting a little bit ahead of itself. Investors chasing exposure to a recovering US retail sector and an improving US economy have obviously pushed the PE up very high here, around 18 times. The yield's dropping down to about 3.5%. So at around $8, the stock really starts to look expensive. So this again is one of those examples that we start to look for an opportunity for it to be a buy on the dip somewhere back at around 775 to 750. CBA, 14.5 times earnings coming into the div. The stock should hold up well into the div in mid-February, but ultimately our preference has been NAB, and we've seen NAB outperform. So across the last couple of months, where the banks have delivered about 10% and NAB's delivered around a 17% recovery, so we've seen, in comparison, NAB outperform by an additional 7% over the last couple of months. So our strategy there of sort of being overweight NAB in this current rally has made sense. Coca-Cola, to look at the PE ratio here again at about 17 times earnings, the stock starts to look expensive. It's on a 4.5% dividend yield with a grossed up dividend yield of around 6.5%. Now the company's already guided to around 4 to 5% earnings growth. So our base case here is that it's a difficult environment for Coca-Cola to trade too much higher than where it's sitting at the moment. So our strategy here is to own the stock at or near these levels, write the covered calls up the top, collect the dividend and collect the premium. If we do get the opportunity to deliver the stock, it obviously increases the annualized returns out of it, but even as a result of the stock just moving sideways, a combination of collecting the dividend and the call premium, we're driving around 12% return out of Coca-Cola at present. Not doing there in CFX. So Computershare is one of those stocks, again, where we've been buyers at lower levels. In some cases, we were forced to deliver the stock under the sold calls throughout this level, but we've tried to sort of reset positions, and we've participated in this rally back up here. Again, in some levels up around the 950 level, we've delivered the stock again, and then we've been buyers of it for this final move into the $10 range. It really gets difficult to continue to be a buyer of Computershare from these levels. So I think we look to deliver the stock under the sold calls at or near these levels, and again, it's not something we would look at until we saw a pullback. So to put that into perspective from a PE standpoint, the stock's trading on 19 times 2013 earnings, delivering a 3.5% dividend yield, and the market's now pricing in an expectation of 15 to 20% earnings growth, 15% in 13 and 20% earnings growth in 2014. So you're already having to pay up significantly for that future growth, and we've always had a view that the stock has the capacity to trade into this $10 range, but at or near these levels it starts to get expensive. CSL, not doing there at present. What I will highlight with CSL is the company still has about another further $600 million to go with their share buyback. So if we are to see a sell-off in CSL, we'd start to look at it, but that sell-off would need to be back down to a pretty attractive level for us to look at the exposure in CSL relative to other opportunities in the market. Crown Casino, again, getting up to extremely high PE. This is a stock that's not really on our radar because we're unable to sell call options or run a derivative strategy over at Dexus, not doing there at the moment. Fortescue, so the opportunity here with Fortescue again, which I chatted about in the previous recording, is the company has the opportunity to offload 49% of their rail and infrastructure assets in the Pilbara, and that'll give the company the opportunity to deleverage their debt position from essentially 50%, from around $10 billion where it sits at the moment back down to around $4 or $5 billion. That combined with iron ore sitting at around this 150 US a tonne starts to look very attractive from an earnings standpoint, where if the company delivers on their target of initially expanding up to 115 million tonnes per annum, and then towards the end of 2013 hitting their target of 155 million tonnes per annum, then the PE valuation of the company really drops down to about 8 times earnings. So it has the prospect of the company trading back up to around $6.50 towards the end of this year, on the proviso that iron ore stays where it is and that the company hits their expansion targets. And that first expansion target will be in March, where the company looks to be shipping around 115 million tonnes per annum as a run rate on an annualised basis, and then again that accelerating back up to 155 by the end of the year. So our view has always been that it was getting expensive as it neared $5, and we're happy to have a look at it over the next month or two. But again, it has to tie in with our view, our macro view on the market, that if we are to get a bit of a sell-off in February and the stock pull back to around 430, then that's sort of somewhere where we'd start to take a close look at it. At the moment, our preference is really BHP, and that has largely been the right allocation up until this point. Goodman Group, not doing anything there as a property play. Happy to look at it if the stock falls back a little bit further. GPT, again, interesting property play opportunity, growing at about 8%, may surprise to the upside as far as its earnings growth potential relative to the other property plays, delivering about a 5.5% yield at the moment. Insurance Australia Group, we delivered this stock after owning it at lower levels, and again we're looking for some level of pullback to re-enter Insurance Australia Group. Iluka, not doing there at the moment. IPL, this sell-off's just been a little bit deeper than we probably expected. We're looking for the stock to continue moving higher. We see fair valuation up at around 350, puts the stock at around sort of 12.5 times forward earnings, and we're looking for earnings growth to really pick up and see growth in 2013 of somewhere around 15% earnings growth. And I think in that environment we see the stock as a buy on the dip. Interesting that we've just had the accumulation signal come up today as we sort of have this higher structural turning point. So that should sort of tie in with our view that the stock gets bidded up at a higher low than here, and ultimately we see it sort of move back up to around 350 coming in to the earnings update out in May. Leighton, so we're seeing sort of divestment of assets here at Leighton's with NextGen and the waste management division there, which will help them reduce the gearing on the balance sheet. The real issue there with Leighton's is obviously potential risk exposure from investments in the Middle East, and how transparent the company's been about reporting those and writing off the underperforming investments in the Middle East. But it's a long-term recovery story here, Leighton's. It's one of the few stocks trading on a low PE, still at the moment about 8 or 9 times earnings. We're looking for 2013 to deliver somewhere around 500 million profit. To put that into perspective, that's about half of what the company was delivering going back about 4 years ago. So the two issues the company has to deal with is de-gearing the balance sheet, but in the process they'll be selling off assets that obviously produce profit. So the company's got to replace those profits through organic business growth, and in that environment, arguably, if we could see Leighton's re-accelerate earnings from around 400 or 500 million up to around 600 million in 2014, the stock's worth around sort of $22 to $24. So it's trading on a low multiple at these levels, but there's certainly some risk attached to Leighton, so it's not a stock that we're preferring to have an allocation to in the portfolios. Lendlease trading 10 times earnings, should deliver around 10 to 12% earnings growth going forward. From a dividend yield standpoint, the stock's yielding around 5%. We're comfortable that there's not a lot of downside risk in Lendlease from these levels, but again, our preference has been to sort of stay allocated in the banks and BHP really is the core part of the portfolio at present. Mirvac Group, we're owners of this at 150, looking to get out at around 165, stock delivering around 5.5% dividend yield and about 8% earnings growth. Reasonably comfortable with that position. Macquarie, so Macquarie's expensive on any measure, and whether that's compared to other investment banks globally, whether it's looking at what the likely earnings rate of Macquarie is likely to be. So they delivered roughly $700 million of profit last year. This year they're going to need to deliver something around $1.1 billion of profit to justify the valuation that the company's trading on at present. So when you start to look for, I suppose, a shorting opportunity in the market coming into a potential sell-off in global markets, and I don't think we're there yet. I think the US market has further to rally, but certainly Macquarie is something that arguably could have a fairly sharp pullback when that time comes. So again, our preference is to stay exposed to the Australian banks. We possibly give up a little bit on the upside, but hopefully don't have that same volatility when some level of market correction occurs. So NAB, 10 times earnings. We've seen some rumours in the market about a Spanish bank coming in to buy Clydesdale in the UK. That was quickly dismissed overnight, and that was essentially what was responsible for this little rally here that we had from sort of the to a $26 level up to around $26.80. But the market was able to hold on to that level today. Really, if NAB was able to dispose of their UK business and you just took a fair multiple on the Australian business and essentially on the $5.5 billion of profit that NAB produces, fair valuation for the stock's around $27.50. So it gives you sort of some indication of where the market will start to re-rate NAB if there is any truth to the prospect of them finding a buyer for the UK assets there. So in that environment, tied in with our fact that we think the banking stocks can push a little bit higher from where they are, I think over the fair value for NAB is probably somewhere between this $26.50 and up to around $28 as the market sort of has this final sort of push from where we sit at present. Newcrest Mining, so poor production numbers over the last 18 months have obviously weighed on the stock price. We've always had a view that coming into sort of the first quarter or really mid this year, the company will have an opportunity to sort of prove to the market that those poor production numbers are behind them. Those production numbers are running about 20-25% below the historical high water mark. From a valuation standpoint, if gold holds at $1,600 an ounce, we think that Newcrest could easily trade back up into this $30 range. I think given that our macro view is that, albeit there could be some volatility in the US dollar over the next month or two around the debt ceiling, the primary trend for the US dollar is down, and that should still remain supportive for gold prices. And obviously we're seeing central banks globally printing money with Japan, ECB, and the US, and we've spent time in previous recordings where we look at the M1 money supply, which is the amount of US dollars in circulation, and the relativity to the gold price. And I think that all sort of bodes well tied in with this sort of poor production environment that Newcrest is in at the moment, where Newcrest should ultimately be a buy on the dip, and it may be something that we look back in sort of 6 months' time and recognise that these are reasonably low levels. So from a short-term perspective, we've been buyers of it from this dip down here at around sort of $22, looking for the stock short-term to trade back up at around $25.50. News Corp, I think the company still has roughly 60% of their second round of share buyback still to go. So that was $10 billion that the company announced as share buyback in total. I think tied in with the bullishness that is taking place in sort of the US equity market and economic recovery at the moment, News Corp should remain sort of well supported. The stock's trading about 14 times earnings, and obviously we've got the pending breakup coming through in June of essentially the old media assets from the new sort of media assets, and I think you're seeing a fair bit of positioning in the stock ahead of that. So again, this is a name that we have owned it from lower levels. We sold out arguably a little bit early. We've been buyers of it again on this dip, and even for new money coming into the market, if we were to see a little bit of a sell-off over the next month, still comfortable being an owner in News Corp, mainly supported by the fact that the company still has another $3 billion odd of equity to buy back over the next short number of months. Origin Energy, so again we've been buyers of it as a recovery play off this lower level here, looking for it to rally back up eventually into this sort of 1350 range. The catalyst for the next leg in the rally, I think the valuation adjustments happened. The company's already guided to pretty flat earnings in 2013. The stock's back at 15 times earnings, so there's not a huge catalyst to drive it sort of from here. From an earnings outlook, really it comes down to sort of this confirmation that JP Morgan's able to place the equity interest in the LNG asset that ConocoPhillips is teaming up with Origin to offload, so roughly around 15% equity interest, and that'll help support the valuation of the project. And in the face of sort of that announcement coming through from JP Morgan in the next 2 or 3 months, we're trying to keep long exposure to Origin, albeit that we're mindful that where we own it at lower levels, certainly an opportunity to take profit and maybe keep some cash in the account for a potential pullback in February is something that we're mindful of across sort of client accounts in general, as well as our own internal account. Not doing there in Orica at the moment. Oil Search, not doing anything there. Our preference really is BHP and Woodside. To the extent that we do have exposure in Oil Search, it's really at lower levels, and we've sold the 725 calls into March, so comfortable sort of delivering the stock. I think Oil Search just has a little bit of time to work through after the blowout in the capital expenditure sort of hurting market sentiment a little. I think what will gradually heal that process is a more bullish outlook for oil prices, which we have throughout 2013, and ultimately as the company starts to come through with better quarterly production numbers and better results from their drilling program, will help to underpin Oil Search. And I think throughout sort of the mid part of this year, it certainly would present a buying opportunity if the stock was to pull back below $7. Qantas not doing there at present, so QBE, we've seen in the news there around the company reducing staffing numbers and trying to focus on cost control. The real issues here for QBE haven't changed, in that we've obviously got a low risk-free interest rate that the company is exposing the premiums to, which is impacting earnings, and we're seeing regularly the board disappoint the market from a guidance standpoint, where we're seeing insurance margins sort of continue to come in at the lower end of the range. So at the moment, I think the best outcome for QBE is we get into an environment where the stock price stabilises from a technical standpoint at around this $12 level. We've still got this sort of lower low, lower high structure, which is generally sort of bearish or negative for the market. Rio Tinto, so as with BHP, so when we look at the iron ore prices at these prices, stock's trading about 14 times earnings. Go out to 2014, we start to see that PE come back to around 11, 12 times earnings, so the stock starts to look like reasonable value. I think that, again, in line with the outlook, the macro view, Rio could push a little bit higher. Our preference has been BHP over Rio as a result of their energy portfolio, and we're pleased to see sort of that start to show through in today's results. I think at around sort of $71 to $72, Rio gets pretty much fully priced. So to the extent that we own it at or near these levels, we're selling calls up at around this level, but broadly our strategy's been to gradually try to diversify out of sort of any overexposure to Rio into BHP, the banks, and to get a little bit more defensive coming into sort of that February period. Stocklands at the moment, so flat to negative earnings growth, roughly a 5.5% dividend yield, fair value for the stocks at around this 350 level, but not a core part of portfolio allocations. Sonic Health, I think if we were to get a sell-off back down to around 12.75, 12.90, it's certainly a buy on the dip. I'd expect as we go into February, Sonic to actually be bought up on any sell-off here, so it might present a buying opportunity for us to look at in the week or two ahead. Santos, so we saw their production numbers come out, no great surprises there. We've seen reasonably flat revenue and reasonably flat production numbers across the last number of quarters. The stock's trading about 15 times earnings. I think fair valuation is up at around $12, maybe $12.50. So we were owners of it at lower levels here, and if we get an opportunity to sort of take profit around the $12.50 level, that would be an adequate sort of return on Santos. Not doing there in Suncorp at the moment, looking pretty expensive short term. Sydney Airport, so I've obviously seen in the media the issues around the ATO ruling, around the deductions that Sydney Airport's claimed with some of their trust distributions. That's weighing on the share price, but the underlying business is performing very well. Traffic numbers for the December quarter were up roughly sort of 3%. Even when you factor in a negative outcome for the issues facing them from the ATO perspective, it might strip around 10 to 20 cents of value off the 2013-2014 earnings numbers, or valuation numbers, I should say. So the market's really adjusted, largely adjusted for that already. I think somewhere around this $3 level the stock starts to look attractive. We've just started to sort of dip a toe back into the water on Sydney Airports. We obviously had been buyers of it throughout last year and making money on it from the rally. We started to sort of steer clear of the name once it got past about 320. It started to look a bit expensive for us, and back at around this sort of 290 level, we're certainly buyers of it again. TCL, we're happy to own it at or near these levels, delivering roughly a 5.5% dividend yield, looking for the opportunity for Transurban this year to trade back up to around 650. I don't see it has the capacity to trade beyond that, so we're happy owning it at these levels, collecting the dividend and selling the call, and delivering sort of around that 15% return out of Transurban, a little bit higher if we were to see the stock rally up to our target of 650 and get exercised. Telstra paying its dividend mid-February there. The stock is likely to be well supported coming into that dividend period. We might see dividends increase from 28 cents up to around 30 cents on an annualized basis. And the stock trading at around a 6% dividend yield, so still well supported from a dividend yield standpoint. From an earnings growth standpoint, we don't see a huge uptick in earnings, so really from here just becomes a matter of can the market re-rate Telstra further and compress that dividend yield. I think maybe coming into the div the stock could push up to around 460, but I would expect it to be pretty flat post the dividend. Toll Holdings, so we like this name from a defensive standpoint. We think that the company should deliver probably about 5% earnings growth, trading on roughly a 5.5% dividend yield at these levels, and therefore we're buyers of it on a pullback. So coming into February, if we were to see the stock back below sort of this 475 level, we'd certainly take that as an opportunity to buy. Westpac, on the other hand, we're happy continuing being exposed to Westpac. We've been owners of it sort of from lower levels here, and around $27 we start to take profit as part of this strategy of getting in towards the end of January and locking in some of these gains that we've had and looking for some sort of pullback in that period of February. But we're not quite there at the moment on these banking stocks, again tied in with our macro view that the market remains bullish throughout US earnings season. Australian market pushes a little bit higher at around 27.50. We start to take a look at locking in some short-term gains on Westpac. Same thing for all the banks growing at 5%, delivering a 5.5% dividend yield. Westfield getting very expensive, 4% dividend yield, trading up at around 17 times earnings. The stock is expensive on any measure, so at around these levels, certainly taking profit. And I think some time over the next sort of 3 to 6 months, we will actually see a more substantial pullback in Westfield and will create a buying opportunity at much lower levels. Wesfarmers trading up at around 18, 19 times earnings, already paying up for around 10% earnings growth. I think the company can deliver that, so I don't expect any great disappointments. And here's where we see sort of historically where Wesfarmers and Woolworths have been trading at around 13, 14 times earnings, and we're seeing these multiples now up around 19, 20 times earnings. In normal circumstances, that would be crazy for these assets given the earnings growth that they're delivering, but obviously with the yields being low, or the cash rate being low, the bond rates being low, that we're seeing this sort of rush for dividend yields. And in some way the equity market, where the risk discount that would normally be applied to equities is diminishing a little bit as a result of this sort of rosier outlook for global GDP. So as a result, we're seeing the PEs expand and the dividends compress on almost the certainty that the companies are going to deliver the earnings growth. But ultimately that still becomes dependent on global GDP actually coming through and delivering the supportive backdrop for companies to improve their earnings profile to support the valuations where we're at the moment. The caveat to that is obviously if interest rates continue to move lower, if the RBA does in fact drop interest rates by another 50 basis points this year as the market is expecting, the valuations in these names from a PE standpoint could certainly stay high, and therefore we're believers in the view that global GDP is re-accelerating, and we think sort of anything that might present, say, a 5% pullback in the market in February would be a buying opportunity. Worley's not doing there at present. Woolworths, again, getting very expensive, 16 times earnings, 17 times earnings up here. The company's delivering 5% earnings growth. The dividend yield's falling down to 4%. We were looking for the market to be bullish throughout US earnings season and coming into our dividend period, but I think once we get sort of post-dividend, I think we could see Woolworths back at sort of around $30. Woodside Petroleum, we're looking for this as a recovery play. We're seeing better production data out of Woodside. We've got a more optimistic outlook for oil prices or crude prices going forward, and I think ultimately that sets the environment for Woodside to trade back up to around $37. So we own it at around $33, $34, and we've sold the calls up at around $37.50 into the next few months ahead, looking for the stock to continue rallying up to those levels. Westfield Retail pays an early dividend in February within the property play. So your Westfield Retail, GPT and Mirvac are probably our preferred property exposures at present. Westfield's delivering around a 5.5% dividend yield. We own it at lower levels from around $2.90. We're delivering it into tomorrow's option expiry at around $3. So we generated roughly 20 cents of income out of that trade across the last 3 months. And then we've, in some cases, bought back into it again at $3, and we've gone out and sold the 320 calls. So we collect the February div and the premium from those 320 calls, and that'll deliver roughly a 30% return or a 10% return for 6 months, or 20% annualized out of Westfield. So from a property play exposure, our average annualized return out of these investments is certainly pushing up above 15 and nearing 20%. In situations where we're delivering the stock under the sold calls. And just to conclude tonight's presentation with a short-term sort of outlook on the market, our general view for 2013 is that the market would remain buoyant throughout this sort of January period off the back of US earnings. from a valuation standpoint, you could see as we're going through tonight, a lot of stocks are compressing down to sort of 4% dividend yields, PE valuations up around 19, 20 times earnings, already valued for 10 to 15% earnings growth in 2013 and in 2014. So there's certainly a lot of momentum from a global GDP standpoint that needs to come through over the next 12 months to continue to push equity markets higher. I think what's likely to happen is we continue to move higher through this period at the present. We get some level of pullback around the debt ceiling. I think that will be obviously resolved favourably, and we'll then get a relief rally at some point following that, and the market will probably move higher in towards that May period. And then when you look back across the last 3 or 4 years, or at least the last 3 years, seasonally from May through to September, equity markets have been a little bit weak, and that could quite easily play into that theme where we could start to see added commentary begin to build around the Eurozone again, coming into German elections, the issues that Spain's going to have to face with the bailout. We've still got issues there with Cyprus, still got issues there with Greece, and obviously the ECB is at the backstop there to do whatever it takes. But I just think at the margin some of those issues will start to creep back into the headlines mid-year and probably weigh on valuation. So I think probably between now and May will largely capture the most part of gains for 2013. So we continue to ride this rally up, and then just be mindful that we're sitting on some cash coming into February to take advantage of any pullback in the market. Thank you for listening to tonight's recording, and look forward to speaking again next week.